This is a video demonstration on bonds. In this video, I'm going to work the example solution to example number 1. This example involves the Baxter Company, and they have issued the following bond. It's a $100,000 20-year bond bearing 6% interest. The interest payments are to be made semi-annually, and the current market rate for a similar bond is 8%. Under the requirements, number 1, we must determine the issue price for the bond. Number 2, we will prepare the journal entry to record the issue of the bond. And number 3, we'll prepare the journal entry to both record the first semi-annual interest payment and amortize any discounts or premiums, assuming straight line amortization. Now, the first step in a situation like this is to calculate the issue price of the bond. That's going to be based upon the present value. So to do this, we're going to utilize our present value tables. Now, to set this up, there's certain things that I want to put first in order to work with. So the first thing that I want is the principal amount of the bond. Now, it said in the information that I was given, this is a $100,000 bond. So I'm going to start off with the $100,000 because I'm going to have to work with that. That's the principal. And then just below that, I want to put the amount of an interest payment. Now, you have to be careful with these interest rates. Notice that there are two different rates. It says that the bond bears 6% interest, but that the market rate is 8%. See, the way that works is, this is the contract rate, this is the market rate. The contract rate is going to help me determine the amount of interest payment, but the market rate is going to help me determine the present value. So it's important to know when to use these rates. Now, in this case, it is a $100,000 bond, and the contract rate is 6%, but it also says that the payments will be made semi-annually. So if I take that $100,000 and I multiply that by 0.06, that gives me $6,000. So that means the bondholders are entitled to $6,000 interest every year. But they're going to get the money in semi-annual payments. So I actually want to use half that, and I want to use $3,000. So notice how I had to do that. I had to cut that in half, because if they're going to get 2 payments a year, they would get $3,000 with each payment, and between the 2 payments they'll get the $6,000. So you always have to do that whenever you're dealing with a semi-annual bond. Now, the next thing I want to find are some present value factors. I want to calculate the present value of both the principal and the interest, and then once I get those values, I'll add those together. Now, the principal of $100,000, that will only be paid out a single time at maturity. But this $3,000, that's going to be paid out every 6 months recurring. So in order to do this, I want to use the present value of 1 for the principal and the present value of an ordinary annuity for the interest. But I've also got to figure out the interest rate that I want to use and the time span. Now, remember I said market rate, that rate is used to get the issue price. But this is a semi-annual bond. So a lot of people would be tempted to use 20 years and 8%, but you can't do that. This bond is semi-annual. So I'm going to have to cut that interest rate in half and use 4%, and I'm going to have to double the number of periods to 40 periods. Why do I have to do that? Well, think about it. If I'm going to make a payment every 6 months, then 6 months will occur 40 times in 20 years. And I have to cut that in half to show that I'm getting 4% at each payment, and between the 2 payments, it would be 8%. So I want to cut that in half and double that. So I really want to use 4% and 40 periods. Now, to get my numbers, I have to utilize my tables. Now, these time value tables that I'm using, they are available in the textbook, and they're also available on our class website. And I have these posted in a PDF format, so everyone should be able to open these tables and use them. So this is the present value of 1 table. Now remember, I want 4% and I want 40 periods. So I'm going to go in that 4% column. I'm going to go all the way down until I hit 40 periods. So that's going to be right about here. So in that 40th line, but in the 4% column, the number that I see there is 0.2083. So 0.2083. Now I want to do the same thing with the interest payment, but for that I have to use a different table. For that one I have to use the present value of an annuity table because the interest is being paid out recurringly. So again, I want to find 4%, and I want to go down to the 40th period. So in the 4% column at the 40th period, that is 19.7928. So that gives me my two factors in terms of the actual present value factors. That's actually the hardest thing about this problem, because it's so easy to accidentally use the wrong table or look in the wrong area. Once you get these numbers, the rest of it's pretty easy. So I'm just going to take my principal, multiply it by that factor. I'm going to take my interest payment, I'm going to multiply it by that factor. I get two answers. I just simply want to add the two answers together, and that gives me the issue price of the bond. So the present value or issue price of this bond is $80,208. And that completes part one. Now, whenever I do a present value calculation, one thing that's a good thing to think about is to double check to make sure that your answer is correct. And there's different ways that you can do that. The best way is to look at the interest rates. If you go back and look at the information that I was given, contract rate is 6%, market is 8%. Now remember, in the lecture video that I did on bonds, I said that if the contract rate is less than the market rate, that means that bond will be sold at a discount. So that means the present value or the issue price, we should expect the answer to be less than $100,000, and it is. It's only $80,208. So when you do that, that's just an extra way of double checking, because it's so easy to accidentally look at the wrong table or look at the wrong number or forget that it's semi-annual. You got to cut the rate in half. You've got to double the number of periods. So there's so many little ways there, little opportunities to make a mistake. That's always good to double check and make sure that the answer that you get makes sense in the context of that situation. So now that we have that, now we're ready to proceed and actually record on part 2 and 3 our journal entries. Now the first journal entry, this is going to be the entry to actually issue the bond. When I issue the bond, I sell it for cash, so I can debit cash. At the same time, I'm obligated to one day pay this back. That's a liability that we call bonds payable. And since that's a liability, I'll credit that. And notice that I skipped a little bit of space there. I want to leave myself a little bit of room. Now on bonds payable, I want to use as a credit amount the face value of the bond, which in this case is $100,000. But up here on cash, we know from part 1, we're actually going to sell it for $80,208. So it's going to be $80,208. That's going to be the amount of cash that I receive, because this is a discounted bond. Now you see why I left myself some additional room there, because this journal entry doesn't balance. I need more on the debit side to make it balance. In fact, what I need there is another $19,792 in order to make the journal entry balance. And what is that going to be? That is simply the discount. So this bond was sold at a discount. So that completes part 2, the journal entry to issue the bond. Now the third part of the problem, we have to do one more journal entry. Now this journal entry has a dual purpose. This journal entry is going to record the interest payment and at the same time amortize the discount. Now when I make these interest payments, that is an expense. In fact, it is a bond interest expense because it's costing me money to make these interest payments. And I'm going to skip a little bit of space there and credit cash, because when I make the interest payments, I pay for it with cash money. Now on the credit to cash, how much am I going to use there? Well, back on the first part, we calculated that each interest payment would be what amount? $3,000. So that's going to be $3,000. Now, I have to amortize the discount. Amortizing the discount simply means to get rid of it. Now think about it. The discount is a debit. If I want to get rid of something that has a debit balance, how can I do that? With a credit. And it said that they use what type of amortization? Straight line amortization. So basically, I've got to get rid of this $19,792 discount. How many opportunities do I have to do that? 40 opportunities, because I'm going to make 40 interest payments, 2 a year for the next 20 years. So for my discount amortization, I'll just simply take that $19,792 and divide that by 40. And that rounds out to about $495. So the final piece of the puzzle is to debit the bond interest expense for $3,495. And basically what will happen is I will continue for the next 20 years to make these interest payments, and each time, little by little, I will remove $495 from that discount so that eventually the discount has been fully amortized and we get rid of it. So that completes part 3, and that completes this example on bonds.